A $2 billion silver delivery demand just hit the COMEX, and the exchange's response raises more questions than answers. Within hours of facing requests for over 36 million ounces of silver plus 58 tons of gold, the entire COMEX system reported a critical data failure. Coincidence or crisis management? The timing suggests something far more significant is unfolding beneath the surface of precious metals markets. Smash the like button, drop your thoughts below, and subscribe for more critical silver market updates. What we're witnessing isn't typical market behavior. Open interest on COMEX remains surprisingly low, while prices climb to new highs. Gold and silver are advancing without the speculative fuel that normally drives major rallies. Instead, the pressure is coming from a completely different direction, and it's exposing vulnerabilities in a system built on assumptions that physical delivery would remain the exception rather than the rule. Market analyst Alistair McLeod highlights a pattern that defies conventional market dynamics. Gold and silver continue marching higher, yet COMEX open interest tells a contradictory story. Gold's open interest sits near 420,000 contracts, levels typically associated with market exhaustion rather than robust uptrends. Traditional rallies in precious metals attract speculative money, traders pile in, open interest expands, and momentum feeds on itself. That's not happening now. The speculative buying pressure remains minimal. This rally is being driven by forces operating outside normal futures market mechanics. Silver reveals where the real tension concentrates. The large institutions that typically maintain short positions on the paper side are discovering they cannot easily exit those positions. Some analysts suggest we may be observing the early stage failure of the silver derivative structure in both London and COMEX markets. The logic is straightforward. This system functions only as long as the short side can roll positions, hedge exposure, and absorb periodic pressure. When that capability erodes, the entire mechanism begins seizing up. The machinery depends on liquidity and willing counterparties. Remove either element and stress appears immediately. Reports circulated through the Shanghai Gold Exchange and Shanghai Futures Exchange about someone preparing to execute a massive stand for delivery in Western capital markets. Shortly afterward, COMEX faced demands for more than 36 million ounces of silver in a single delivery period, accompanied by roughly 58 tons of gold. This wasn't random market noise. This represented a coordinated acquisition of physical metal on a scale that strains system capacity. The delivery request totaled approximately $2 billion worth of silver alone. And precisely when this pressure hit, COMEX reported a data center failure. The official explanation cited overheating. Industry experts note that data centers of this scale typically operate with not just one complete backup cooling system that automatically engages if the primary fails, but often maintain a secondary backup as well. Complete failure across redundant systems raises legitimate questions about whether technical malfunction or operational stress triggered the shutdown. Now here's where the delivery data gets really concerning, and you need to understand what these numbers actually mean for market stability, whether the timing represents genuine coincidence or suggests deeper systemic stress. The physical pressure is becoming increasingly difficult to conceal. The pattern indicates participants demanding actual metal rather than maintaining paper exposure through futures contracts or exchange-traded products. Andy Scheckman examines the numbers, and the picture becomes clearer. Just 3 days into the December delivery cycle, COMEX already faced requests for nearly 24,000 gold contracts, representing approximately 2.4 million ounces of metal. Silver showed even more intense pressure, with over 8,300 contracts standing, translating to roughly 42 million ounces. December is a scheduled delivery month, but the pace still stands out. What makes this particularly notable is the context from preceding months. November typically isn't a heavy delivery period, yet November saw close to 20 million ounces of silver and more than 1.2 million ounces of gold leave the exchange. Off months aren't supposed to behave that way. This year they have, and December is accelerating the pattern. Day 1 of the December contract saw 7,300 contracts stand for delivery in silver, representing almost 37 million ounces worth over $2 billion. While not quite a record, it approached the April high of just under 12,000 contracts. Within 2 days, the exchange had already processed requests for 2.4 million ounces of gold and nearly 42 million ounces of silver. Schechtman emphasizes this isn't an isolated spike. Physical delivery has remained robust throughout the entire year, and the velocity is increasing. Since the beginning of October, approximately 90 million ounces of silver have drained from COMEX inventories. That volume doesn't reflect a relaxed market operating with comfortable margins. It reflects a stressed system where growing numbers of participants want metal they can physically hold rather than futures contracts or fund shares. Schechtman uses a simple analogy. For years, everyone assumed the cookie box was full. There's a picture of cookies on the outside, and participants traded based on that assumption. Now people are opening the box, reaching inside, and discovering there isn't much left. If you're starting to see why this matters, smash that like button and make sure you're subscribed, because what comes next explains why the derivative structure itself might be breaking. When participants realize the box contains far fewer actual cookies than the paper claims suggested, the pretend cookie trading game falls apart. Real cookies, physical gold and silver, become substantially more valuable. That's precisely why prices are rising, while currencies that represent claims rather than tangible assets look increasingly weak. The precious metals futures market runs on trust. Participants believe they'll receive delivery of what was promised. That trust, built up over decades, allows the system to function. You buy a contract, you stand for delivery, the metal materializes. This mechanism has set the price of gold and silver for generations. The system resembles a bridge engineered to handle specific weight loads. It functions perfectly until it doesn't. Schechtman references the Interstate 35 West Bridge in Minnesota that collapsed despite handling millions of crossings. The structure worked until stress exceeded design capacity, then failed catastrophically. Similar dynamics appear to be developing in London and COMEX markets. The enormous short positions in COMEX futures, combined with massive short positions in the SLV exchange-traded fund, create vulnerability. Simultaneously, the London Bullion Market Association operates on extremely thin inventories. The delivery mechanisms show signs of breaking down under pressure they weren't designed to handle. The situation intensifies because the usual market participants can't lean on leverage the way they historically could. When buyers insist on removing metal from the system instead of rolling contracts forward, the traditional mechanics stop working. That kind of fundamental shift doesn't announce itself with dramatic headlines. It manifests through stress fractures that accumulate until something gives. If silver reached $96 by year-end, analysts suggest it wouldn't be unreasonable given current structural dynamics. Looking at geological footprints and historical ratios produces even more striking calculations. Taking 4,200 and dividing by 7 produces approximately $600 to $605 per ounce. As extreme as that sounds, it would match geological abundance ratios. The calculation reflects silver's relative scarcity compared to gold in the Earth's crust. Many analysts consider silver the asset opportunity of a generation precisely because these structural imbalances are becoming impossible to ignore. What makes this situation so unusual is how thoroughly it contradicts normal precious metals rally characteristics. Typically, speculative interest floods in during major advances, open interest expands, fast money piles onto momentum. None of that is happening now. Instead, the rally proceeds without speculative fuel. If anything, the squeeze is hitting the establishment paper positions. The large institutions that typically dominate the short side of these markets are finding it extremely difficult to close out their positions. That difficulty suggests we could be witnessing the end of effective silver contracts in both London forward markets and COMEX. That's a significant statement. For as long as serious observers have tracked the relationship between physical metal and derivatives, Some have argued that derivatives suppress gold and silver prices. If that suppression is ending, massive buying pressure will emerge from that source alone as participants holding paper exposure realize they must shift into physical metal to maintain actual price exposure. The fascinating element is that this isn't being driven by buyer aggression. It's the shorts refusing to extend their positions further. They're attempting to control their exposure. And worse, they're discovering that the limited number of buyers in the market are standing for delivery rather than engaging in the traditional roll-forward behavior that keeps futures markets liquid. Drop a comment with your perspective on whether we're seeing a genuine derivative failure or just temporary stress, and subscribe so you don't miss updates as this situation develops. The rumor that originated in Shanghai about a large Western delivery stand suggests the massive silver delivery request came from Chinese sources, or at minimum, from that region of the world. The information apparently circulated within those markets before the delivery demand materialized. It's entirely plausible that someone preparing to stand for $2 billion worth of silver might mention it to associates. The rumor pattern supports the theory that Chinese sources executed the delivery demand. Whether coordinated or opportunistic, the action put immediate stress on a system already operating near capacity. The clues are aligning in ways that become difficult to dismiss. A quiet futures market paired with surging physical demand doesn't occur when systems function smoothly. The inventory drawdowns, oversized delivery demands, and sudden reporting failures each add weight to the conclusion that the paper side of precious metals markets is losing its grip on price discovery. When traditional players cannot lean on leverage and buyers insist on extracting metal from the system instead of maintaining futures positions, the old mechanics stop functioning. This type of shift doesn't announce itself through mainstream financial media headlines. It shows up in stress fractures, unusual data patterns, and system behaviors that deviate from historical norms. Whether this resolves gradually or snaps into something more dramatic remains uncertain. What is clear is that the balance between paper claims and physical metal is tilting faster than most market observers expected. Physical demand continues chipping away at inventories while open interest stays muted, creating conditions fundamentally different from typical precious metals rallies. The repricing mechanism may already be shifting from futures-driven discovery to physical metal-dictated valuations. When actual metal, rather than paper contracts, begins determining the narrative, participants positioned in physical assets will experience very different outcomes than those holding derivative exposure. The bridge analogy becomes more relevant with each passing delivery cycle. Systems handle stress loads until they don't. The question isn't whether the bridge was properly engineered for historical conditions. The question is whether current stress exceeds design parameters. If this analysis helped connect the dots on what's really happening in silver markets, smash that like button one more time, share this with anyone tracking precious metals, and subscribe for continued coverage as these events unfold. The story is gaining traction as more participants recognize the structural transformation underway. The price of silver may be just beginning its repricing journey as the gap between paper claims and physical reality becomes impossible to maintain.